If I woke up tomorrow with nothing, no portfolio, no positions, just a broker account and whatever I could scrape together to start again, this is exactly what I do to build it all back to a £1 million portfolio. And honestly, I'd probably get there faster the second time. Let me show you why. I'll be honest, losing everything and starting again would be brutal. Like, it's taken me years to get where I am, but I know I'd do it well the second time because I would avoid the big mistake that I know most people would make in that situation. Because if people lost all of that, they would do their best to try and get it back as fast as possible. Now, when you try and rush an investment, it means you're going to take emotional decisions and higher risks. That's not what got you the success in the first place, because that's the thing you need to remember. What got you there originally is exactly what you need to do again. Don't do something totally different and expect to get the same result. So the first step of the rebuild would be figuring out what money I can get together to start again. So that might be, how much have I got in my savings? Or maybe I've got some premium bonds that don't win at all. Or maybe I've got some other investments that aren't doing so well that I could dip into to take the money. So that'd be the first thing. But I'd need to know what money I'm working with, because how I would invest 5 grand, for example, would be very different to how I would invest 100 grand. When I'm teaching people to invest using the VAC strategy, I typically say to people, start with like 500 or 1,000 pounds just to get used to it, and have an amount of money in there that you wouldn't want to lose. Like, you take that seriously, but it wouldn't keep you up at night because it's so stressful. That would be the advice I give new people. Now, in this scenario, assuming I knew everything I know now, I would probably say start with like at least 1,000. The more the better, obviously, but that would be the minimum I'd want to start with, just to start seeing it grow. If I was using below that number, less than 1,000, probably I'd think stacking cash would be a better idea. So when I say stacking, I don't mean just stuffing it under the mattress. That might just be putting the money into like a really low risk index fund, maybe the S&P 500, just so that you're putting money away to save it or to store it, but it's still making a bit of a return. See, if I was starting with only 1,000, I probably wouldn't split that across all 5 stocks, because then each one would have a very, very small amount in, and the returns probably wouldn't be worth my while. So that might only go across like 1 or 2 stocks, and that would be easier. Obviously, if I've got more capital, it's easier to spread that across 5 and have a decent chunk in each. So if I had £5,000, well, then I'd do 1,000 on 5 different stocks. Keep it nice and simple. So when picking my 5 stocks there in that scenario, I would make sure, of course, they fit my fundamental 13. That's a non-negotiable for me. However, from that list, I might choose some companies that could potentially move a bit more than others. So on the list, typically, we're going to have some stocks that are a bit more steady, a bit more maybe established larger companies, and then maybe some medium-sized companies who are very, very fundamentally secure, but do move a bit. Now, if I'm trying to build a portfolio from scratch, I might try and opt for those ones that might have a potential of a higher upside. Whereas if I was focusing on the small, steady ones, then maybe that's going to take a bit longer to grow. Now, the beauty is with this strategy, when your portfolio grows and you go from 5 grand to 10 to 20 to 50 to 100, so on and so forth, the strategy itself doesn't change, which means the workload is identical, whether you've got 5 grand or 500 grand, exactly the same amount of work. But the great thing about growing that is you can afford to take even lower risk when you've got more money. You can go for those super secure, super steady companies, because the actual profit you get out is still a huge chunk of money, right? If you're investing a large chunk, any percentage on that is going to be a really tidy sum. So that actually gives you more flexibility the bigger your portfolio grows. So how I would enter into each of those stocks that I chose would be the way I always enter my investments. It's not just throwing all your money in one go, which is a mistake loads of beginners make. They just think, oh, here's a stock I want to invest in. This is the amount of money I've got. Here you go, hoping it goes up. Well, that's very risky, obviously, because when you invest in a stock, it can either go up or down. So if your only plan is that you hope it goes up, you're going to be wrong at least 50% of the time. So what I do is I break my investment down into chunks, and I invest a little bit if it gets to this price. And then if it falls further, great, I'll buy some more at a cheaper price. And if it falls further, I'll buy some more down there. It's something called averaging. So I do that. When you're using a lot of money in your investment account, that's really important, because you want to be able to not go all in one go, of course. When you've got a smaller amount of money in your account, it's even more important, because if you do put all your money in one go and you haven't got a lot, well, if it goes against you, you've got no backup plan. It's not like you can be like, oh, well, I've got more money sitting over here I can put in to buy some more. You can't. So when you're using a smaller chunk of money, particularly at the start, you want to really make sure you've budgeted that out into different increments. And then, of course, the other side of it is when to sell. So as part of my strategy, always, I know what my profit targets are before I even get into the investment. So essentially, I know where I'm going to sell before I even buy. This just means I can be so prepared up front, and then I don't have to make any emotional decisions. So the plan is get into 5 stocks. When one of them gets to my profit target, great, I'm going to sell that one. So the money comes back into my account with the profit. So now I've got some more money to invest. And then I look for the next investment to replace that. And then, as I said, I've obviously got my initial investment plus some profit to go into the next one. So each investment starts to grow itself rather than me having to add more and more money to it. The number of rotation cycles you really need to go through before you start seeing some serious increase obviously depends on how much profit you make on each of those stocks. Because, you know, if you made 10% on the first time and 10% on the second one or 10% on the third one, well, that's cool. But if one of your stocks really exploded and you make 30% on one, well, obviously that's like 3 investments in one go. So it could speed you up a bit. So I would say you probably need at least a year of reinvesting the money to really see it start to grow there. And honestly, if you just get 1 or 2 big wins throughout the year, that totally transforms your portfolio. Now, this is where the discipline comes in, the patience, because once you see your account start to grow and your money starts to go up, the temptation is to then be like, oh, well, it's working so well. Let me tweak that. Let's see if I can do it a little bit faster, or I can make this a little bit better. You don't want to do that. If something's working, do not change it. You got to stick to it. So this strategy is very rinse and repeat. Once you've done it correctly once, you do it the second time, you do it the third time. You just keep doing that over and over again. And honestly, that's so unsexy to most people, but that's what makes it sexy, because if it's boring but it works, they're the things you're going to stick to and actually get the result in the end. And unfortunately, of course, we're all humans, so that instinct to try and speed things up and tweak things, it does happen occasionally. But the irony of that is when you do start to tweak things of something that's working, you actually break it and end up making mistakes that either mean you make bad investments or you actually accidentally pick an investment that's going to take longer than you meant it to. So in actual fact, you slow down your growth rather than speeding it up. So that's how I'd think about picking what to buy. But picking the right stocks is only half the battle. The other half is what you actually do once the money's in. And when you're rebuilding, that part matters even more. If you want to see the full filter in action on real stocks, I walk through it inside a free masterclass at thetradetribe.com. The link's in the description. Now, let me talk about how I'd actually run the rebuild day to day. So this is what the day to day actually looks like to implement the VAX strategy. You're not going to be staring at your screen all day, just waiting for something to happen. Not at all. Actual fact, you actually only check it once per day and maximum of 5 minutes. So all I do is I'll open up the app on my phone to see the investments I'm in. And I'm looking for 2 things. Has this stock dropped enough in price for me to want to buy some more and get a good deal? Or has the stock gone up enough to hit one of my profit targets and be time to sell? Now, some days it has done one of those things. Amazing, I can take the action. A lot of days I look at my 5 and none of those things have happened, so I can flick through them quickly and I'm done in about 20 seconds. That's a pretty good day. And here's why I would get there faster the second time round. Because when I did this originally, when I was building my portfolio, I didn't have the strategy as it is now. I was actually doing a totally different thing, right? I was doing my day trading, which was far riskier and really slowed me down if I look back. I didn't have the really strict criteria for selecting stocks. I didn't have my specific entry points. I didn't have my specific selling points. I was really doing it on a lot more emotional basis, quick thinking, decision making, and honestly, it was a mess. So having this structure now where I do this step, then this step, then this step, I would get there way faster than I did the first time round. Because you have to remember, the portfolio itself isn't the asset. The strategy, the system is the asset. The portfolio and its results is just the outcome. Having that asset of the strategy that I can follow step by step means that I know I could start from zero again and achieve the same result, but in much less time. One mistake I've made many times, particularly in the early years, was I was trying to go for the big wins, the home runs as I like to call them, because I really thought that's how you build wealth. I thought you had to hit these big, massive wins, huge percentage of profit, and that was all it took, just needed a few of those. Well, the reality is going for those meant that I took so much more risk when I really didn't need to. Because something that people don't know about stocks, even the biggest companies in the world really move a great percentage. So you can make money in them without having to go for the small risky ones and just hoping that they shoot up. And I wish I'd learned that lesson sooner. Another big benefit of me doing this the second time round would be I'm very used to the numbers now, and I'm actually very detached from the numbers. And this is quite an important thing that people need to understand, because I know when I first started and I had small amounts of money, I cherished every single penny that was in there, and it felt like it was something so precious that I had to keep, and every win was a huge win for me. It felt so good. Every loss was a real pain. It hurt, and that shouldn't be the case. If I look now, because I'm used to using the investments, having different amounts of money in there, I'm totally detached from the outcome. In fact, I see the numbers on the screen as points rather than pounds, and just that little tweak there has made it so much easier for me to not worry about every bit of money that's in there. It's just points on a screen in a game. Now, if you find yourself in this position right now where you are starting from scratch, from day one, you have a huge advantage over me, because rather than going and making all the mistakes that I did, spending the years trying to figure this all out, you can actually bypass all of that and just learn my strategy so that you get to succeed from day one. But I would have loved to have this approach when I first started, because I'd be way further ahead than I am now, and it wouldn't have taken me so long. So don't see where you're at as a disadvantage that you're starting from scratch. You actually get to start from a really strong point and only do it the correct way. So that's the rebuild plan. Filter, enter, manage, rotate, repeat. Simple. But here's the thing I keep coming back to whenever I think about this scenario. I know I'd get there faster the second time. And the reason has nothing to do with the market. That's the full rebuild plan. If you want the guided version, the exact filter, the screeners, the templates, and me walking you through it live, the free masterclass is linked in the description. If you want the full system broken down step by step, go watch the free course on this channel. It covers everything from the pillars to the exit rules to the psychology. And if you haven't started yet, stop thinking of yourself as behind. You're not rebuilding, you just build it. Same plan, same process, same 5 minutes a day. I'll see you in the next one.